I'm sitting with Michael Cole, Vice President of the Technology Industry Group at Bank of Ann Arbor. Michael, what is the Technology Industry Group?
Well, we're a group within the commercial group of Bank of Ann Arbor, focused on serving the needs of technology, life science, angel investment community, and the venture capital community.
And so why don't you give us a little bit of an idea of how many opportunities you might look at in a year, how you classify them, an overview of this financing activity.
Okay. Well, as far as opportunities for bank financing go, maybe 2 or 3 opportunities a week pass through our desk that we're working on. And then also with our activity in the angel investor community, probably an equal number of companies looking for angel financing. We'll see in a given week, in a given year.
How does bank financing differ from angel financing? Why would one go with angel versus bank?
Well, generally, angel financing is going to be a little bit earlier than bank financing, just generally speaking.
Okay.
And the objectives of the 2 different parties are a little bit different. For bank financing, banks are looking for a return on their capital. So
Right.
we're looking to lend some money, make a little bit in the process for providing money for a certain period of time to a company, and then getting the capital paid back. As opposed to equity investors, which are more interested in a return on their capital. So they're looking to invest some money and make a big return on it.
Okay.
And
are they willing to take a little bit more risk too?
oh, absolutely. Yeah,
Okay.
the equity players are absolutely taking more risk.
Give us an idea. So let's say that I had a business. When would a business typically approach you for bank financing?
Well, that's a great question, because I think a lot of times, some of the earlier stage companies, they're not certain whether it's bank financing or it's equity financing or what type of financing is available to them. And generally, I mean, as far as this general business banking goes, you're looking at the traditional type of bank financing is to finance accounts receivable growth, inventory growth, and things like that. What we specialize in doing as well, in addition to that, so in addition to providing accounts receivable, inventory growth financing, you might be expanding your facilities and need financing for that, maybe buying a building for your business, need financing for that. Those are traditional business banking type of financing requirements. And what some of the other things that we do by focusing on tech companies and life science and then working in this angel investor community are providing loans to the earlier stage type of companies. And again, that is very situational. We're going to look at the management team and what the business, the variable, the viability, what it looks like, what are the sources of repayment that we can look to, and again, what stage in the life cycle the company might be at. So that's kind of working with these earlier, maybe angel-backed type companies.
Right.
And then we also, our newest product and service set is in the venture capital community. So providing what they call capital call lines of credit for venture capital firms themselves, as well as venture debt financing for their portfolio companies.
Let's kind of make it clear for everybody. What does it mean to finance accounts receivable growth? What do you mean by that? Well,
again, generally a business banking formula for that would be a bank line to finance, let's say, 80% of what they would call a borrowing-based formula. So you'd look at your accounts receivable on any given day and say, okay, let me take 80% of that, and that is so I've got a financeable asset there of up to 80%.
Okay.
That's the general formula that's used in commercial banking, business banking.
Is that sort of more of a revolving line of credit that I can use to finance my daily business activities?
Right. That's generally how those would be structured, kind of a 1-year revolving line of credit.
Okay.
So you can borrow, and then when you collect your receivables, you'd pay the line of credit down, and as you built up receivables again, you might borrow against the line to finance, the project or whatever it is that's creating that receivable.
Now, how long would a company typically be in business before they would come to you and try and present their receivables as collateral for a loan? Do you ever have companies coming to you like in their first year of business, second year of business?
Yeah, absolutely.
Okay.
The longer that they've been in business and the stronger their track record of cash flow and profitability and things like that, the easier it gets to kind of lend against those receivables.
Okay.
In the earlier stages, oftentimes you're trying to find other ways to structure the financing to shore up the collateral position for the bank.
What are some of the other assets that people might bring to the table? when they're trying to finance their business?
Well, oftentimes for the earlier stage companies, before the company itself has a track record,
Right.
You're looking to the assets of the owners,
Right.
as well as for collateral. It might just be their personal guarantees on the loans. That would be an unsecured guarantee, and oftentimes you see secured guarantees where people will pledge marketable securities accounts or second mortgages on homes and things like that to back the loan up to the company.
How long would a company typically have to be in existence before you would consider financing just on the basis of receivables?
You know, it's not so much a question of how long. It's really how strong has the company become, and what kind of track record, of profitability do they have? Is it,
Okay.
Is the profitability up and down? Is the
Right.
cash flow up and down? Is it steady? And how much? There's different structures for companies too. So there's C corps and there's LLCs and things like that, and some of those have different tax strategies involved with them.
Right.
And to build up the financial strength of the company requires the owners to kind of leave money in the company as opposed to distributing all the money each year as well.
Okay. Okay.
And so that's one of the things when you're looking at companies, you have to be aware of, that there is that kind of fungibility of cash between the owners and the company oftentimes. And if you're lending to the company, especially to an early stage company, you're going to want to make sure you have some control and understand where the cash is going at the end of the day.
I suspect there's a difference between doing things like funding receivables growth and inventory growth, and then making a loan to fund a new building or a new piece of equipment. Am I correct in that, or not?
Right.
Okay.
Yeah.
Okay. And when you're doing a new piece of equipment, a capital expenditure, basically, ultimately you're looking at that piece of equipment as the collateral base for the loan. Is that?
Well, you're looking at it as one of the ways to get paid back.
Okay.
So banks are typically going to try to figure out at least two ways to get paid back.
Okay.
And their number one preference is going to be, cash flow from the business.
Right.
The second one will be whatever that collateral position is. So in this case, a piece of equipment. And if there's, well, the reason that buildings and equipment are maybe better types of collateral is that you can value those a little bit better than you can a receivable oftentimes.
Right.
Especially if it's a service-based company and they have a service that maybe partially has been delivered.
Right.
So it's if the company were to go away, how collectible is that receivable?
Right.
Becomes a big question. It's different if I've sold you a widget and you own it and you're using it. That's a pretty solid receivable. So
Right.
somebody else like a bank could come in there and go, okay, we need to collect that to pay our loan down. So you're looking for to firm up that collateral position. What's your backup source of getting repaid? Like I
Okay.
said, banks are interested in getting repaid. The return of their capital as opposed to the return on their capital.
Right. That's the first thing you want to see is the business is in good shape, and then being conservative, wanting return of your capital, then you're saying what are other sources, and you typically want at least two possibilities for getting the return of the capital. And so you would start to look for the asset itself, the receivable or the piece of equipment.
Right.
And then there might even be a third guarantee, which would be, the person's house or something like that.
Right.
Okay.
Right. And oftentimes, again, it's with particularly the earlier stage companies where you can't really the level of risk, we'll say, in the cash flow is pretty high at that point.
Okay.
So they haven't gotten to a point where they can demonstrate, this business cash flows.
Right.
So you're heavily discounting that possibility as as kind of the primary source.
Right.
So then you're looking at, okay, what's my collateral and what's my backup collateral? And at that point, again, the management team and the viability of the business is key at that point.
Right.
And understanding who your borrower is.